the expectation here, and obviously this is all leading up to COP. You're an advisor to Boris Johnson, and also, of course, obviously playing an important role through the United Nations. How important is COP, which will be, I guess, maybe a bit of a potentially a rule-setting meeting in getting listed companies and sort of investment themes where they need to go?
Yeah, I think it's incredibly important. And what we've seen over the course of the last 18 months when the UK, in partnership with Italy, has been the president of this COP process is countries, starting with countries, have moved from less than a third of countries having net zero commitments to 3/4 of countries having net zero commitments. And then underneath those commitments, more and more policies consistent with that. For example, President Xi's announcement yesterday. But what's happening is those net zero commitments are cascading down from the country level to companies. We've got more than 3,000 companies around the world who have net zero commitments and are developing the most rigorous plans associated with that, science-based plans. And of course, the financial sector is moving in the same direction. And as we virtually meet today, we almost have $90 trillion of balance sheets. That's $90 trillion of balance sheet controlled by companies, financial firms, banks, insurers, asset managers, asset owners that themselves have committed to manage that money towards net zero. So the COP process has brought net zero from out of the shadows into the mainstream. And it's really an organizing principle for finance, for business, and ultimately the economy.
And of course, you yourself helped lead a team that is, making decisions today, Mark, based on an understanding of where things might go. But the final rules, and if we can put it that way, the pricing of those investments haven't really been baked in. It's an interesting position for you to be in, but it's an interesting position for a lot of people to be in. You happen to have a hand in influencing the policy, which makes it doubly interesting. But there's a lot that's not known about the outcome of some of these investments. How much uncertainty is there on that front?
Well, it's a great way, but the way I'd frame it is this. Let's start with what's known. We know the objective, which is to get to net zero. People can have different opinions about the speed with which an individual country or the world will get there. That makes a market in and of itself, but we know the objective. Secondly, we know that there is a range of technologies. The most prominent would be solar and wind, elements of storage, other technologies that are commercially profitable today, that are highly attractive today, and actually play a huge role in decarbonization over the course of the next decade. So one of the simplest things, at least conceptually simplest things, is rolling out renewables at scale, rolling out renewable charging for zero-emission vehicles at scale, and that transformation. Because another thing we know in Canada, in the UK, in Europe, is that there will be no new internal combustion engine vehicle sales from 2030, 2035. So we know where the world's moving for those types of rules. And therefore, there's huge investment opportunities today. Now, the more growth equity component of this, or venture capital end of the spectrum, is for technologies associated with the other 40% of emission reduction that we will have to do. So think hydrogen, think carbon capture and storage, direct air capture, sustainable aviation fuel, machine learning, AI applications for optimization, those types of technologies. But we know a lot, and that lot that we do know is associated with a delta of investment of over $1 trillion now that needs to ramp up. So the opportunity set's huge, and depending on your risk appetite, there's a huge spectrum of ways to deploy capital.
Well, there's also such a huge range of what ESG investing could be, right, Mark? On the one hand, you could say, well, this is a retail company that has a very diverse board, which makes sense because then they can sell their product to more people, right? But it could be something that's not a great product for the climate. On the other hand, you've got, what truly are carbon capture, wind power, really climate positive investments. How do you decide where to go in that range?
Well, it's a great question, Matt. And I think in some respects, the answer to your question is embedded in that question because the element of broader ESG that is the most measurable, concrete, and to some extent, in terms of the scale of the opportunity, is around decarbonization investments that are taking emissions from up here and moving them down on that path towards net zero. That's in many respects the easy bit of impact investing, and certainly the most impactful for the climate. But that's not the alpha to omega, as you put it, of ESG. Much broader issues around environmental sustainability in terms of biodiversity, other elements of nature, and then, of course, very importantly, the social and governance factors. It's important to have common data for that, and that's something that for COP, actually, we're delivering. The IFRS, which is the body, Bloomberg terminal users will know this, is the body that provides the financial disclosure for basically everybody but the U.S., is going to set up a new pillar, a second pillar for sustainability disclosure, so we have consistent standards around that. They'll start with climate, start with climate disclosure, and then move on. But there is an element when you move further away from net zero to broader ESG, we need common data, but you need to make those judgments, including the ones you just referenced.
Yeah.
Mark, one of the things that we seem to be seeing at the moment are obviously judgments are being made by some of the biggest players in the sectors involved. And we've seen it with big energy companies with their long-term investment plans. We've seen it on the part of big investors with their plans to support the sector. And so we're seeing high prices. And those high prices, in fact, could persist. When we look at the capex for oil and gas relative to demand, we could find ourselves in an inflationary sort of a cycle. Certainly, we're watching things like natural gas right now with concern. In terms of the effects that persistent low rates have at a time when we also may have these pressures coming because of the shift in investing patterns, how much of a concern should that be for the globe central banks?
Well, I think central banks, regardless of the underlying cause of a move in prices, have to make a judgment whether those are transitory or have an element of persistence to them. Let's take a step back. First thing, in terms of global energy, to be absolutely clear, we have far more fossil fuels, proven fossil fuels, whether it's oil, gas, certainly coal, than we need. And to be more specific, then we can possibly burn and control the level of the climate. In most cases, twice as much. In the case of coal, we can only really afford to burn about a quarter of it. So we have more than we need, and there will be teething issues in producing that which is consistent with the transition. But more broadly, in terms of, and to go back to what does the energy transition mean for the economy, for growth and prices, look, this is a very big, very positive investment shock to the global economy. We need to increase the scale of investment in overall energy infrastructure. It'll be on the renewable low carbon side as opposed to the oil and gas side, but we need to increase that by $1.5 to $2 to $2.5 on some estimates $1 trillion a year. Put that in context, that's about 2 percentage points of global GDP. And that is about the size of the famous savings glut that developed over the course of the early 2000s and has persisted. So that's a big shift if it comes to pass. Now, people will have different views about how quickly that will move and how rapidly that'll have an impact, but that will have an impact on, in my judgment, there's other factors, but in my judgment, the overall level of global interest rates. But tangibly, in terms of people's lives, it'll have a positive impact in terms of the speed of growth, the number of high-quality jobs. Oh, and by the way, a better environment for everybody.
Well, first, I want to point out that Porsche and Siemens are working together on a synthetic fuel that pulls carbon out of the atmosphere, mixes it with water, and drives the 911. So save the whale tail is going to be my hashtag for that. You mentioned rates, and I just want to ask, get back to your central bank hat and ask you what's happening with global rates right now. It looked like we were headed to 1 before 2 on the U.S. 10-year. And all of a sudden, today, after the Bank of England decision, we shot up 10 basis points on gilts, 10 basis points on treasuries. What do you think is going on here?
Well, look, I'm fortunately no longer a central bank governor, so people can stop listening. Second thing is I'm not following the day-to-day, but in the broader context, I think what's going on, and look, there's lots of challenges, we all know that, but the broader context is we have a global recovery that has momentum, that has potential to broaden out. The more progress, by the way, we can make at COP, the more we're going to provide medium-term strength to that global recovery because of the investment I just talked about. On balance, it's reflationary. On balance, it moves up global rates. On balance, it moves things in the direction we need. So now that's not a day trader comment. That's a longer-term direction. Global rates ultimately headed to sub 1% is not consistent with the form, in my judgment, of recovery we're currently on, first point. And then second, if and as we deliver on these types of climate goals, look, this is an investment boom that we can help to put in place. We happen to need it for broader reasons, but it will have tangible impacts, in my judgment, on the nearer term growth trajectory.